Good afternoon. This is Sean Golden with Golding and Golding, here to discuss the basics of international tax compliance and penalty resolution. Either you just filed your taxes, you're considering filing your taxes, someone told you you're supposed to report that fixed deposit you have or that superannuation or CPF or life insurance policy, etc., etc. Let's go through the basics. International tax compliance is a big deal with the IRS, probably for the past 10, 15 years. I mean, the FBAR has been around forever. We'll get to that in a minute, but ever since the U.S. had entered into deferred prosecution agreements with Switzerland back in 2008, created FATCA. 2012 is when the reporting began for individuals on their U.S. tax return, the 2011 tax return. And since 2014, there's been over 110 FATCA agreements. The IRS is really honing in on this. And when it comes to international tax compliance, there's two key components, right? There's the taxation of your foreign income, and then there is the reporting of your foreign assets, accounts, and investments. Let's start with reporting. When it comes to reporting, let's take a step back. Let's start with tax, right? When it comes to tax, the general proposition is the U.S. taxes, and we're focusing on individuals, right? Corporations, partnerships, different ball. Here we're just focusing on individuals. Individuals have to report their worldwide income if they're U.S. persons. U.S. persons includes U.S. citizen, lawful permanent resident, foreign national who meets a substantial presence test. It doesn't matter if it's exempt overseas unless possibly there's a treaty article that may avoid taxation. The baseline perspective is wherever it's earned, it's taxed. Doesn't matter if you reside in the U.S. or abroad. If you reside abroad, you may be able to make certain treaty elections to be treated as a foreign person, but there's also certain tripwires you have to be aware of, especially if you're a long-term resident, long-term lawful permanent resident. When it comes to foreign tax, there are things such as the foreign tax credit, which may reduce or eliminate your tax liability, the foreign earned income exclusion, which may, and foreign earned housing exclusion, which may reduce your tax liability in the U.S. depending on how much income you earn. But at the end of the day, baseline perspective again, worldwide income. Okay, no matter where you earn it, it's taxable. Reporting is a little bit different. Reporting can be much more complicated for the fact that most people don't know about it. They think, oh, it's only for people who have offshore, people who are earning significant amounts of money overseas, but that's not really how it works. If you meet any of the thresholds for reporting, then you have to report. Some of the common forms include the FBAR, Foreign Bank and Financial Account Reporting. It's not a tax form, but it's enforced by the IRS. The threshold is if you have more than $10,000 on any given day of the year, not per account, an annual aggregate total. You have one account with $100,000, you have 8 accounts with $1,500, you'd have to report all of them. FATCA is the Foreign Account Tax Compliance Act, works similar to the FBAR, except you report it directly on your tax return, and there's different thresholds depending on whether you're married filing joint, married filing separate or single, and whether you reside in the U.S. or reside abroad. Another enforcement priority for the IRS as of late, which is completely and utterly ridiculous and unfair, is foreign gifts. And what happens is if you receive a gift from a foreign person, it doesn't have to just be one gift. If you get a series of gifts, let's say you get a gift from your foreign non-resident alien mom for $200,000, or you get 5 gifts of $30,000, then you have to report the total each year on Form 3520 if you miss the requirement, because when you do your Google research, you'll probably find that you typically don't get taxed on foreign gifts, and you miss it, well, the IRS could penalize you, and they penalize you upwards of 25% value of the gift. You got a $600,000 gift, math, $150,000 penalty just for not reporting. No one reported income, just didn't report the form. They used to have a procedure to automatically avoid the penalties, but they've modified that, and we'll get to that in a minute. Important facts in terms of resolving international tax issues. So whether it's tax or reporting, there are certain commonalities that people have when they get dinged from the IRS on international tax. The first are assessable penalties, okay? Things like Form 8938, 3520 are called assessable penalties. What that means is they just assess them. You don't get the opportunity typically to go on an audit, exam, a warning notice. You get the assessable penalty typically on a CP15 notice, and you have 30 days to learn what to do and to protest it so you don't miss any sort of requirements, okay? So assessable penalties is sort of the first common issue many people have. Reasonable cause. In order to issue the penalty. Well, let me rephrase that. The IRS can't issue the penalty if you can show that you have reasonable cause and not willful neglect. But unfortunately, even if you have reasonable cause, the problem is you could take two totally reasonable people and spit out the same set of facts and circumstances to them, and one agent may think it's reasonable cause, one may not. It's based on the totality of the circumstance. There's no specific bright line test. Where it starts to get murky is, what do you do after you get the penalties and you try to fight it with reasonable cause at the protest letter at the outset, and it doesn't work? Well, typically what will happen is your first opportunity is going to be called an appeal. The problem is, with the appeal, if you do the appeal and then it doesn't, the appeal is the IRS Office of Appeal. It's supposed to be independent, third party, right? Supposed to be. And the appeal can be very effective, right? But if the appeal doesn't work, then typically it's stuck there. You don't really get to go on to tax court except in very limited and narrow situations. Otherwise, some people will wait for a collection due process hearing. Collection due process hearing is an integral part of international tax compliance, because if you do it, and by the way, when you do collection due process hearing, you have typically a good shot of dealing with someone there that's going to listen to your case, at least assess your facts and try to give you a fair determination. But if it doesn't work, you have more opportunities to go to tax court. Why people prefer tax court instead of federal court is you don't have to pay first for tax court. You can just go. And oftentimes taxpayers will represent themselves. If you're out of compliance and you haven't been penalized yet, one of the best things you could do is proactively get into compliance with an opportunity to write the narrative, right? Because you're not on the defense, you're on the offense. So there are various offshore disclosure programs you can use to get into compliance. You'll hear words like offshore voluntary disclosure. They all refer to these types of amnesty programs. And if you're willful, or you just can't certify under penalty of perjury that you're non-willful, you do the voluntary disclosure program, VDP. If you're non-willful, you have a lot of other options available to you. Do the streamlined procedures, reasonable cost, delinquent FBAR, delinquent form reporting. So there's a lot more opportunities that you have depending on your facts and circumstances. We have a ton of free information on this stuff on our main websites and our sub-websites. You can always reach out and schedule a reduced fee initial consultation if it's something that we handle here. Again, my name is Sean Golding with Golding & Golding. Thank you for your time. Enjoy the rest of your day.